This looks like a move by an outfit called Robinhood, which is supposed to be taken from the rich and given to the poor, and doing exactly the opposite.
Nope. Yeah, that's it. Done. How's it going, guys? It's your friendly neighborhood nerd man, data scientist Andrew, as well as Meatball, the Golden Core Gale graduate, and today we are going to tell you exactly the updates on Robinhood, the lying CEO, as well as where GameStop is going and what you need to know. As always, I'm going to include exactly what GameStop is doing, fluctuating its little thing down in this corner, right down there, and you can follow along and stay until the end of the video and watch real time it's fluctuating up and down. The amount of positive energy coming from the comment section is electric. Almost every one of you is giving the same amount of positive energy, except this person who says that this kind of insight is not really what a data scientist perspective can provide. Well, today I promise you one thing. If you smash that like button, if you subscribe to the channel, I promise you that I'm gonna make it boiled down so that the Joe Schmo, the normal person, can understand, and also provide a technical, statistical, there's even confidence intervals about exactly what's happening with Robinhood and GameStop and why Robinhood is continuing to restrict GameStop buys. In my first video, I explained exactly what a short is and what's happening with GameStop, an over-shorted asset. In the second video, I explained why the dip was happening and what the hedge funds institutions are doing to interact with that dip. And 3, I explained exactly what happens if you decide to sell your stocks, the prisoner's dilemma of the GameStop world. Now, today I'm going to talk about Robinhood and how it ended up being the largest players in favor of the hedge funds. You probably have heard that Robinhood is one of many brokers that decided to restrict the buying of GameStop and therefore created a market where people could only sell. People could not buy any more stock, in which case, hey, guess what supply and demand does? Guess what buying and selling does to the price of a stock? It plummets it. The excuse that Robinhood gave was that it was running out of liquidity. And if you don't know exactly what that means that every time you decide to buy a stock, Robinhood has to put aside a certain amount of money, just as collateral so that you can get as close to real time as possible the price of that stock. However, the volatility of the stock price combined with how many people were trying to buy made it so that Robinhood could not afford to back up the volume of buys with the cash on hand. That's liquidity. However, if this is true, the CEO of Robinhood went on CNBC last week and lied. Just straight up lied. And what did he lie about? Well, at the very least, we can verify that Robinhood has cash on hand to put out a Super Bowl ad amid the GameStop saga. So they have money for a Super Bowl ad, but not enough to hold down the fort. Okay. Sometimes you get to get your priorities straight. However, what does this interview say about Robinhood and its actual financial liquidity?
But it sounds to me, though, that you're suggesting that there was a liquidity problem inside the firm. And my question about that then raises all sorts of new questions about whether there's a systemic issue underneath the system and underneath the company unto itself.
No, there was no liquidity problem. And to be clear, this was done preemptively.
Evil Keanu Reeves is the CEO of Robinhood, and he is making a lie right here. He is either lying about the liquidity of Robinhood or he's lying about something else even more sinister. And that's something that I'm going to cover in this document with the statistical section coming up soon. So get to this timestamp if you want to hear a data scientist's perspective right away. I took a second to have lunch so you can see that GME is going up and down wildly. This could be attributed to the fact that GME just got a brand new CTO, an ex-Amazonian on board. And that means that, hey, diamond handers, bag holders, I'm talking to you. I'm talking to me. I'm talking to people like me. I'm talking to people like you. GME is mobilizing. They're getting ready. And they're not going to leave you behind in the dust. Moving back to Robinhood, the point is that they have lied about one thing or another, either having not enough liquidity or it's not about having enough liquidity, it's about another thing. It's about this, it's about that.
The reason we did it was because Robinhood is a brokerage firm, lots of financial requirements, including SEC net capital requirements and clearinghouse deposits. And they can be substantial in the current environment where there's a lot of volatility.
You're suggesting that there was a liquidity problem
No, there was no liquidity problem.
What skinny Adam Driver is trying to say is that it's not my problem. Look away. Don't look at the big Super Bowl ad that we're putting out. We don't have enough money. Actually, not having enough money is not the big deal. I think Louise Rossman figured out exactly how to make this make sense. For example, let's say that your landlord comes and asks you, where is the rent? You know, is my rent ready? And you say, oh, I don't have enough money to pay this month. And then you try and figure out exactly what is happening with his rent situation. And then you look in his checkbook and say, hey, it turns out you do have enough money. And then I say to the landlord, oh, it was never about my money. It was about a completely different issue. Either way, Scary Keanu Reeves has made it clear. It's not about liquidity. It's about something else. And that is the statement that he is currently sticking with. I promised you some statistics, so that's why I want you to point to this article by STU2B50 back on Sunday of last week. First, what happened on that fateful day? GameStop stock had massive volatility, and given the cries of buy and hold from Wall Street Bets, I'd assume on Robinhood, a broker targeted at retail investors, it'd be heavily imbalanced towards buy trades. However, as volatility increased, the DTCC, that's the Depository Trust and Clearing Corporation, increased the deposit requirements for brokers. Basically, when you submit a trade on a broker, the exchange of money for stock doesn't actually happen until 2 days later, and the firm that handles that exchange is called a clearing firm. Before then, Robinhood just sends records. So John bought 2 GME for $600. Mary sold 1 GME for $290. If that's all that happened that day, then Robinhood would need to provide $310 to the clearing firm and receive 1 stock. You see, mathematically, back to math class, that's a credit risk. What if Robinhood doesn't have the money on settlement? The clearing firm would be on the hook. So the DTCC requires that brokers put up a deposit beforehand. On that day, the DTCC massively increased deposit requirements for brokers, and as they quote, a spokesman for the DTCC wouldn't specify how much it required from specific firms, but said that by the end of the day, industry-wide collateral requirements jumped to $33 billion, up from $26 billion. So there is that liquidity issue right there. Oh, I don't have, what is that difference? $7.5 billion. The DTCC said that there are new requirements for how much collateral you have to put up, so therefore, Robinhood's in the clear, right? Well, Robinhood legally could not submit trades on GameStop until they could muster the deposits for GameStop that they needed. So they quickly scrounged up some capital so that they could continue on Friday. All right, seems like Robinhood's in the clear. Clearing firm? You get it. Robinhood actually has their own clearing firm, Robinhood Securities. For some reason, it's still a DTCC member and must listen to what the SEC regulates. So why only buys? Well, the deposit requirement is deposit equals the minimum of either 99% 2-day VAR plus gap risk measure, or the deposit floor calculations, and then plus mark to market. Whatever that means, you can understand as essentially there's 2 possible values that this deposit could have, and right now it is one or the other. The variable to look at is the very first one. The volatility component is designed to capture the market price risk associated with each member's portfolio at a 99th percentile level of confidence. The VAR charge is the volatility component applicable to most net unsettled positions and usually comprises the largest portion of a member's required deposit. Procedure 15 of the rules currently provides that the VAR charge shall be calculated in accordance with a generally accepted portfolio volatility margin model utilizing assumptions based on reasonable historical data and an appropriate volatility range. As such, NSCC currently calculates a member's VAR charge utilizing the VAR model and incorporates an EWMA volatility estimation. So remember when we were talking about John and Mary? John buys 600 and Mary sells 290. Well, that's the broker's net unsettled cash positions. So generally speaking, the 99% VAR is 99% of the time the broker's net unsettled will not be higher than X. If you remember confidence intervals, hey, you wanted the data science stuff, so here is the confidence interval that we wanted to talk about. For simplicity's sake, usually distributions look like a normal curve. So the y-axis is probability and the x-axis is Robinhood's net unsettled positions. So the more positive, the more money they'd owe theoretically. So you see that green bar go up, that means that they owe more and more money. So if people buy more than sell, then it would shift more to the right. This is because if people buy more than sell, then they have to put up more collateral, which means that they have a lot more unsettled positions than normal. And now the most important part is that if we stretch out the distribution, which is what happens when it's a super volatile market, then the green bar, the one that measured how many unsettled positions Robinhood currently has, it goes even further to the right. So now buys make it worse, sells make it better. Robinhood could not execute buys because it would increase the deposits they need, which they legally must obligate by. So sells, on the other hand, do not have this problem. They would not push the 95% boundary more to the right. So the final decision, these brokers halted buys of GME, Robinhood, Webull, both of which you can find links up and down below. If you have not transacted yet, you want to get some diamond hands. It seems like this final article's conclusion is that Robinhood is like a young, janky broker. They have to have more money, but as we've proven, as we've seen already, Robinhood's CEO counters his own point. So what is next? Well, the most important thing that you can do is remember to like this video, subscribe to this channel, a ton more personal finance, stocks, trading, as well as industry insights, memes, and more Meatball the dog. Meatball, say bye? Bye-bye. Yeah. Through all of this, I really appreciate it if you look down at the links below. I have a 66-day guide to the data science world. I also have exactly what you need if you're looking for a shopping spree. Use one of the Amazon links down below. And finally, I have to say, I appreciate you for staying to the end. Let's make sure we have these diamond hands. And for now, but not for forever. Peace.